Friday was another big down day in the market with the S&P 500 and SPY down 1.5%, SPY closing at 580.49. Our largest gamma exposure concentration is at the 575 strike. Our lower dealer cluster zone has moved down because of that. You can see this concentration of gamma exposure on the negative side between 570 and 580. So if you recall, last week we were talking about the importance of this bottom zone here right around the 580 strike, and we are pushing right against that lower level. We dipped down below that 580 level on Friday, bounced off of it, and then closed near the lows of the day. As a reminder, we are still in negative gamma exposure territory. Our zero gamma exposure level is above 590, so we've got a ways to go to get back into positive gamma exposure territory, or we need to see a significant shift in the GEX data in the options market. But based on the current structure, it looks like the probabilities are for at least a slight move lower at some point this week. It is OPEX week, so we've got the major monthly options expiration, the January 17th OPEX on Friday. So that could throw a wrench into things. We also have earnings season kicking in gear here. So it's no surprise that the volatility index has picked up quite a bit over this past week, now almost at the 20 strike. This is, of course, the largest gamma exposure concentration. We've been highlighting this for a couple of weeks. We also had a lot of volume coming in on Friday as well. So a tag of the 20 strike on the VIX does seem probable. If we scroll up here, we can see there is a little bit of positioning between 21 and 22 as well. At least from a gamma exposure and volume perspective, nothing until the 30 strike. And so it is possible we could be seeing a larger scale volatility breakout heading into the end of January. That's something we're going to have to watch closely, both from a gamma exposure perspective and from a volume perspective here on our data graph. Next, let's take a look at Bitcoin trading above 94,000. We bounced out of this zone between 90 and 92,000. We've actually highlighted this in multiple videos over the past couple of weeks. We've bounced out of this zone multiple times, and this is our lower dealer cluster zone. You can see how effective it's been at identifying this support level in Bitcoin. And of course, we have the largest gamma exposure concentrations remaining at the 100,000 strike and the 110,000 strike. So the way I like to play these kind of setups is a low risk, high reward type of strategy. And so this is what we do in the Geeks of Finance. We look for these critical support levels like we see here, and we take low risk, high reward setups. So in the case that we're wrong and price breaks down, for example, we're taking a low risk, and so we're not losing that much money. However, if we get a bounce off of the major support and we see, let's say, our target at 100,000 get hit here on Bitcoin, we would have a large reward, potentially 3, 4, 5x our risk. And so that's the type of setup we look for. I love this setup on Bitcoin for that specific purpose. And again, we use these low risk, high reward setups using the options market. And we do this, of course, not just in Bitcoin, but in a number of stocks and ETFs and indices as well. If you guys are interested in learning more, links in the description below. Let's take a look at Google. Google holding up relatively well, trading at 191.72 as of Friday, only down 1.15%. With the broader tech sector, like for example, the Qs were down 1.69%. So Google holding up relatively well. This is another one of those setups where we would look for a low risk, high reward setup. We've bounced off of this zero gamma exposure level, which is hovering around the 190 strike. We've bounced off of that zone multiple times. This 200 strike is the largest gamma exposure concentration. We've already tagged that level twice. We were trading this back at the beginning of December. We locked in some profits there. We're trading for another move back up into that 200 strike zone. And this is one of those setups where taking a position here in the low 190s, something like an out of the money call debit spread, for example, like what the 195-200 call debit spread, just to give you an example, that provides an opportunity to capture this upside move if we get a bounce here. However, on the flip side, if you manage your risk correctly, if this does break down and we see lower prices, your losses are minimized because of that risk reward asymmetry. And so this is where strategy planning, portfolio management, management, risk assessment. That's where all of these factors come into play. Again, super important in these setups, but just broadly speaking, I love these kind of setups where you've got a defined support zone and you've got gamma exposure at higher strikes, indicating that market participants are interested in these higher strikes. So for example, on Friday, we had over 70,000 contracts traded at the 200 strike. So this is basically telling us that market participants are still very, very interested in the 200 strike, despite having already tagged it twice. And if you go back to our previous YouTube videos here, you'll see that the gamma exposure at the 200 level has been there for the last, basically for the last month and a half, and it's still there. So it's just a signal that market participants are still loving this 200 strike. Here's another great example on Palantir. Palantir, of course, down on Friday, down 2.14%, trading just below the 67 level. We've come into a support zone here, a lower dealer cluster right around the 65 strike. You can see this was basically a sort of resistance level before the major breakout up into the 80 strike. Now this gamma exposure concentration at the 80 strike has been there again throughout December, and we tagged that level 3 separate times before finally breaking down back below the 70 strike. And so this to me looks like another one of these potential setups. Does it guarantee that we can bounce all the way back up to the 80 strike again? No, it doesn't. But what it does is it gives you a support level where you can set up a low risk, high reward type of play. Meaning if you enter in here between 65 and 70, you enter a long position, again, something like an out of the money call debit spread. You have a defined risk, which is much smaller than your potential reward. And so if Palantir continues to sell off here, you've got a defined risk. Depending on how you set your trade up, it could be, for example, anywhere between $1 to $2. And you've got outsized reward potential. So for example, if you were buying the 70-80 call debit spread, you could have potentially $7 to $8 of reward depending on your expiration date. And so that's the type of risk reward setups we're looking for. Nothing is guaranteed, of course, but that's how we use this data and that's how we implement it into our overall portfolio strategy. Next, let's take a look at the Qs. The Qs, of course, getting hit the hardest, as I mentioned earlier, down 1.69%, trading 506.58. Now, when we look at the gamma exposure data, we are bouncing, as of Friday, we're bouncing right off of that 505 gamma exposure level. However, we do see gamma exposure growing at some of these lower strikes, as low as 480 on the downside. 500, of course, is the next largest negative gamma exposure data point. So we've been looking at several upside asymmetric risk reward plays, for example, on Google, Palantir, Bitcoin. But let's say you're still worried about further downside in the market, and we come in on Monday and Tuesday of this week and we see the gamma exposure levels growing here. For example, let's say we see the 490 strike growing. We have real-time updates on our gamma exposure data graph, and so you can see this adjusting in real time throughout the trading session. So let's say we've got the 490 growing, we've got the 480 growing, and it just looks like more market participants are piling in down lower on the Qs. Well, this may be something that you use to hedge yourself. You've got several positions, for example, on the upside that are going to capture any kind of larger market bounce. But let's say the market overall ends up falling apart. Maybe you want to have a hedge on to protect yourself. You could do something, for example, like the 500 480 put debit spread. So if there is a further breakdown in the market, we see more volume coming in at these levels, for example, we see gamma exposure growing at these levels, for example. A put debit spread could help hedge your overall portfolio and could offset some of the small losses you have from some of the other upside risk reward plays that you have on. And so using this gamma exposure data helps us to identify potential levels where we can implement our option strategies. So if we see gamma exposure growing at the 480 strike, that might be a strike that we sell puts on while buying puts at the 500 strike, capturing any move down into this zone. And if we had taken positions on, for example, Google, Palantir, and Bitcoin, this market hedge could potentially offset or even help us still make a profit in the case that we're losers on these positions here. And so that's just a very simple example of overall portfolio strategy and using the gamma exposure levels to help improve your trading consistency over time. So if you're interested in learning more, head over to geeksoffinance.com. You can access our gamma exposure dashboard and our option flow analytics by becoming a member. You'll also get access to our community Discord. We've got a ton of great traders in there sharing their trades and information and strategies every single trading session. And you can also follow along in our Geek portfolio. I'll put a link down in the description below so you guys can check that out for free. Thanks so much everybody for watching, and we'll see you guys in the next video.